Hello everyone, it's Professor Reiko here. We're continuing on with our second video in the Cash and Receivables chapter. All right, so this one we're getting into, in your book we'll refer to this as a variable consideration. Okay, so it's possible that the final price, and this, the receivable, can vary based on future events. Okay, that's what we mean by variable consideration. And two common ones are sales discounts, which is this video, and then sales returns and allowances, which will be the next video. So I'm going to define and do an example of each. So if you can see, our definition here for net sales is our sales less our returns and allowances and our discounts. All right, so both of these are contra revenue accounts, which means they will be debit balances. All right, so when we record sales discounts in this example, it will be a debit balance. All right, so sales discounts, what are they? They're just discounts to the buyer for paying quickly. Okay, meaning we're going to offer them a discount if they pay quickly. So this is important. If you're a small business owner and you need cash quickly and you're letting people buy things on account, then you might offer them the discount to have the money come in quickly, because if not, then you're going to be waiting and then trying to collect the money from them, and it'll end up being more of a headache, than possibly just offering a couple % discount on the front end. All right, so it's preferable to record the accounts receivable at the amount expected. Okay, so that's important, the amount expected to be received from the customer. So that's what we call the net method. If not, we'll do the gross method. So what I'm going to do here with this example is just draw a line down the middle of the page, and we'll do both of them side by side. I think that provides for a better comparison. All right, so we've got a company offers credit customers the following terms. All right, so when you see this, what this means is a 2% discount if paid in 10 days with the net due in 30 days. Okay, so 210 in 30 is 2% if paid in 10 days, the remaining balance due in 30 days. All right, so on June 4th, they sold $14,000 worth of merchandise on account. The customer paid half of the balance on June 10th. Okay, so that's 6 days, that's within the 10-day limit. So they're going to get the 2% discount, and then the remaining balance at the end of the month or within the 30-day period. So prepare the journal entries for each. All right, so like I said, what I'm going to do is I'm just going to kind of draw a line down the middle of the page here. All right, so we'll do the gross method on this side, and then we'll do the net method over here. All right, so on June 4th, we make the sale. Okay, so it's going to be accounts receivable, sales, revenue. All right, so that's going to be the entry for both of them. The issue is, what is the number that goes here? All right, for the gross method, we're just going to record the total amount, meaning we're not going to worry about the discount until they actually take it. Over here, though, we're assuming we're going to record net of the discount, which means this number right here is going to be net of the 2% discount. All right, which means it'll be 13,720. So that 13,720 is just 14,000 times 0.98. Right. So the net method nets out the discount on the front end. All right. On June 10th, they pay half of it, which means they're taking the discount on half of it. All right. So over here, we're going to get cash, but we're going to get half of it, 7,000 times 0.98, which means they're taking the 2% discount on the 7,000 they're paying. So they're going to get 68.60. All right, now skip a space here. Accounts receivable still has to come off at 7,000 because they're paying off half of what they owe. They just elected to pay it within the discount period. All right, so you can see we have a difference here of 140. Okay, so this is our sales discount account. All right, now over here on this side, they're still getting cash of 68.60, but we've already accounted for the discount over here because we recorded everything at net. So we would just take the accounts receivable. Notice the accounts receivable up here is already netted. All right, so we would take 68.60 off there. So what you're going to see on this net side is we don't record the discount because we're recording it net of the discount on the front end. All right, and then on July 2nd, they pay off the remaining balance. Okay, so for over here, they're going to pay off the remaining balance, which is 7,000 that they still owed, that they did not take the discount on, and then the 7,000. So the accounts receivable account is now zero for this customer. All right, we have the 7,000 here and the 7,000 here, takes the 14,000 off the books. Now over here, now remember, we accounted for the discount on the front end, all of it, but they only used it on half of it. So here they're going to have to pay us $7,000. All right, we're going to have accounts receivable come off the books at $68.60. So look, now accounts receivable over here is zero, $13,720, and then we had it divided into $68.60 each time. Okay, that leaves $140 on the credit side over here, and we just call this sales discount forfeited. Okay, so sales discount forfeited. All right, and this goes in the other revenue and gains. So it kind of increases income, but we separate it out from our regular sales revenue to kind of just distinguish it from actual sales revenue. So it would go in the other revenue and gains section of our income statement. All right, but either way, if you want to think about net sales over here, it's going to be net sales. If we net all of our revenue numbers, it's going to be the 14,000 less the contra, so 13,860, and then over here the net sales. So we originally quoted it at 13,720, but technically we're increasing it by this other revenue or gain. So the total, even though it be in a different part of the income statement, we're still at 13,860. All right, so this is an easy little problem for a professor to ask on a quiz or a test. All right, so the important thing is anytime you have two different ways to do something, you've got to understand which one is which, okay? And that goes for anything you do. There's a lot of times where there's two different ways to do something. I like to do them side by side when possible, but sometimes when it comes to test time, you really don't have enough time to maybe ask a student to do both. And so you'll ask one. And so you've got to understand if it's the gross method, I'm over here on this side. If it's the net method, I'm over here on this side. Okay, so really make sure you understand the differences between the two so that you can successfully answer these come test time. All right, so this is one of the examples of variable consideration, sales discounts. The next video that I'm going to do will be sales returns and allowances. So we'll also have a gross and net method for that. We'll break it up between whether it's cash or credit sales, and we'll kind of take it through an example with that one as well. All right, so hopefully this helped you better understand these sales discounts. Make sure you use this test time. So I hope you're enjoying it. Please subscribe to the channel. It does help me out. And please share with your friends in the class. Thanks.